Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Wednesday, everybody. Today's video will focus on developments in US-China relations as well as the Chinese economy. In an exclusive report, US-based The Wall Street Journal writes today that American officials led by Jay Shambo, the Treasury Department's Undersecretary for International Affairs, will hold discussions with their Chinese counterparts on Thursday, tomorrow, and Friday of this week. The planned meetings are the 5th gathering of an economic working group formed by both governments last year to enhance communication at a time of heightened competition between the world's two largest economies. The group includes Federal Reserve officials. With the new round of conversations, the US group will seek to build on the warnings expressed by Treasury Secretary Janet Yellen during her April visit over overcapacity concerns which Beijing has publicly rejected as a Western rhetorical trick to suppress its growth, even though previously it has recognized it itself as an issue in the economy, with the 2023 Economic Work Conference being the most recent example. However, the state-driven mechanisms which underpin Chinese overcapacity is central to what Beijing considers its superior system, and to pursuing key national security objectives, and therefore it is unlikely to reverse course, even under international pressure. Jay Shambo, who is leading the US Treasury Group, gave a speech back in July on Chinese overcapacity, which we covered at the time, though, since this trip is now happening tomorrow, it's worth re-examining some of his points. Quote, Chinese policymakers' clear preference today is to push manufacturing even further as China's growth driver, which means taking on an increasingly outsized share of global production, with other countries' manufacturing sectors needing to shrink to compensate. China's size means that its imbalances pose an even greater risk to the global economy. A small economy exports at the world price, but a large one, especially with a dominant market position, can shift global prices and leave the rest of the world to deal with the consequences. When Chinese production is growing faster than its own demand or that of the global economy, the rest of the world cannot absorb China's increase in manufacturing production without being forced to adjust. These conditions would not appear in a normal market economy. What we are seeing is a fundamental distortion driven by government policy. We're not isolated in seeking to address negative spillovers from China's non-market practices. The EU and Turkey have also recently imposed tariffs on Chinese EV imports. Mexico, Chile, and Brazil have taken trade actions on Chinese steel. And India uses tariffs and other trade tools to defend its solar manufacturers from Chinese dumping. And while each country has its own concerns and needs, the underlying reason is undeniable. As the G7 leaders and financial ministers have stated, China's overcapacity undermines our workers, industries, and economic resilience and security. The United States will act, and we will not act alone. The best outcome, though, would be for China to acknowledge the growing concerns among its major trading partners and work with us to address them. End quote. Indeed, this is not just a complaint coming from the US, a Western lie, as Beijing argues, as Yo Han-koo, a former South Korean trade minister now at the Peterson Institute for International Economics, expressed this week, quote, a lot of narratives about Chinese overcapacity are heavily focused on China's trade disputes with the West and on EVs, solar and batteries. But this is something that is affecting the whole global economy, and which is much broader than just the green industrial sector. End quote. Next up, let's now move to the Chinese economy. In recent days, the challenges China is seeing in the venture capital, VC sector, has been making headlines. Chinese financial media outlet Caixin and UK-based The Financial Times have published some of the best reports looking into these issues. Let's examine these reports. First, the Caixin piece, which is called China's Private Equity Investors Left Empty-Handed as Cash-Strapped Startups Flout Compensation Deals. We quote selected excerpts from the piece directly. Private equity, PE, and venture capital VC investors in China struggling to exit their investments amid a slump in the IP market are facing additional hurdles to recovering their capital as the founders of portfolio companies that fail to list on time renege on compensation deals. Although courts are enforcing bet-on agreements that compel companies that miss their IPO deadline to buy back investors' shares and pay additional interest on their capital, business owners are increasingly unable to make the payments, leaving PE VC firms empty-handed. Based on an analysis of hundreds of court decisions, Shanghai-based law firm Li Feng Partners found that courts backed investors in more than 82% of cases involving buyback disputes. However, only 4.62% of the buyback cases that entered the judicial enforcement stage resulted in investors redeeming their investment in full, the firm noted in a recent report. Li Feng Partners' report estimated that in China, PE VC funds will struggle to exit around 130,000 investment projects involving some 14,000 companies. Only a small share of these companies will be able to IPO on time or allow investors to exit through a merger deal, with the majority facing demands for share buybacks, the report predicted. Here is the direct quote. We now move to the Financial Times piece called "How China Has Throttled Its Private Sector." We quote selected excerpts directly. In 2018, at the height of VC investment, 51,302 startups were founded in China, according to data provider IT Juzi. By 2023, that figure had collapsed to 1,202. And is on track to be even lower this year. The Financial Times spoke to 11 executives at VC firms, including from state-run and private funds, as well as industry experts, academics, and entrepreneurs. Most do not wish to be identified as they are not authorized to speak on behalf of their investors, but all painted a bleak picture of what, at its peak, was the world's most dynamic and cutthroat market for founders. Many startup companies sold equity to investors on the basis that they would buy back those shares if they did not list on the stock market or get acquired by a certain date. But a wave of failures has led venture capital firms to try to claw back assets from their insolvent investee companies through the courts. New startups face even more onerous terms. Two executives at renminbi-denominated funds, whose LPs were primarily local governments, say that it is no longer enough that the company is on the hook for repurchasing shares. Founders must take personal liability for the debt. Three separate venture capital executives estimated that state-run funds now accounted for about 80% of capital in the market. The state is taking over the industry in an age of anti-corruption, says one Chinese expert on innovation who declined to be named. It is contradictory to the VC spirit of engaging in high-risk and high-potential ventures. Here ends the direct quote. Before moving on, we note an observation from a US-based Rhodium Group report published last week called "The Mountain is High, the Lead Investor is Far Away." Quote, "The allocation of capital, be it direct grants, credit, or PE-VC investment, does not necessarily follow the objectives announced in Beijing policies. Decades of misdirected investment made it hard for financial actors to now channel their resources to more productive sectors and firms, creating tension between central government wishes and the needs of the financial sector. Beijing wants them to allocate more capital to small companies and emerging technologies, but they need to play it safe by funding large established players and delaying losses in sectors affected by high overcapacity." End quote. Hey everyone, before we move on to the last development for today, if you're enjoying today's video, I have a huge favor to ask. That is to hit the like button, share if you know someone who would get some value from this sort of video, and for those who have not done so already but think they would watch this on a regular basis, subscribing is also a big help. Hit the bell notification and you'll be on top of the most up-to-date China analysis as it's released. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. I do all the work myself 6 days a week, and I want to continue doing that free and open for all. The channel relies primarily on the subscriber support, so if you're able to go that extra mile, it's a tremendous help. Thank you so much. Next up, we move back to US-China relations with our ongoing coverage of the US-China technology war generally and chip curbs specifically. This week, the US House of Representatives China Select Committee learned that leadership of the semiconductor industry are in Washington this week to lobby against the next round of updated export controls. The House body even tweeted, quote, "We understand that several major semiconductor equipment CEOs will be in DC this week to lobby the Biden administration. They hope to weaken export controls President Biden placed on sensitive American semiconductor technology that China hopes to gain." End quote. The next round of semiconductor-related export controls will likely be announced around the second anniversary of the original controls, which were announced on the 7th of October. Veteran China analyst Bill Bishop observed on these developments yesterday, quote, "The Biden administration seems exhausted and not interested in doing much more. Huawei and SMIC should be happy, and should all the US firms that are selling them and various related entities massive amounts of equipment." End quote. RAND advisor Jimmy Goodrick also expressed concern that US controls have far too many leaks to be effective at curbing China's advanced chip ambitions, explaining, quote, "The fence has gotten higher, but we've decided to leave open the front, side, and back gates." End quote. Indeed, in a piece published this week by US-based The New York Times called "How SMIC, China's Semiconductor Champion, Landed in the Heart of a Tech War," Bellett writes, quote, "In 2020, the White House slapped trade restrictions on SMIC after the publication of a report detailing its links to a major Chinese defense conglomerate and military-affiliated universities. SMIC denied connections to the military. The Biden administration later tightened the restrictions, but the rules have allowed for workarounds. Companies have continued selling less advanced equipment to SMIC's new factories by obtaining special licenses and routing sales through non-US subsidiaries and employees. Given these loopholes, some have said it is no mystery that SMIC has progressed." End quote. Beijing appears to have its eye on the ball, however, acutely aware of what is at stake in this technology competition. In the latest issue of ideology journal Jiu, the party group Theoretical Studies Center group of the Ministry of Science and Technology frankly expressed, quote, "The competition for national strength is essentially a contest of scientific and technological innovation capabilities, ultimately comparing whose system is superior." End quote. Adding, quote, "With the complex and severe international situation, the competition among countries to occupy the commanding heights of science and technology is unprecedentedly intense. Our country's development faces risks and challenges such as disrupted innovation chains, obstructed industrial chains, and contracted capital chains." End quote. Meanwhile, today UK-based The Financial Times reports more details on the Japanese government pushing back on additional controls on semiconductor exports to the PRC. We recently covered the news that Tokyo is concerned about a possible PRC retaliation against gallium and graphite supplies, critical to the supply chains of Toyota. Some commentators have expressed frustration at this, pointing out that Toyota and Tokyo have known about this vulnerability for well over a decade and have done nothing to mitigate it. The Financial Times writes, quote, "The Japanese government is particularly concerned China could block exports of critical materials, particularly gallium and graphite, if Tokyo adopts the export controls being pushed by Washington. Beijing has made threats to Tokyo and Japanese companies. Japan and the US have discussed how to limit the impact of any Chinese retaliation, something Washington and its allies are grappling with as they seek to counter China. The US export controls are designed to close loopholes in existing rules and add restrictions that reflect the fast progress of Huawei and other Chinese groups in chip production over the past 2 years. Negotiations have centered on aligning the three countries' export control rules, so Japanese and Dutch companies will not be subject to the foreign direct product rule, which one person in the Netherlands described as a diplomatic bomb. One person familiar with the negotiations said that while it was not easy to generate an agreement, the US had to be careful not to take actions that would cause the Japanese and Dutch to abandon the trilateral mechanism created during the Trump administration that has helped harmonize export controls. End quote. China's dominance of rare earth materials and key supply chains has been part of Beijing's years-long self-sufficiency drive and national security goals, and Western officials are increasingly concerned. Deputy Director of Intelligence and China Issues Manager at the National Air and Space Intelligence Center, a United States Air Force unit, recently expressed during a panel discussion, quote, "The interesting thing that has happened since Russia invaded Ukraine is that the PRC sees this as a blueprint for how they might expect the US and the West to react to a Chinese invasion or military activity against Taiwan. China has taken many steps over the last couple of years to harden its own economy and indigenize as much key technologies to create dependencies from supply chains for key minerals to legacy chips. And so, essentially, if the West tries to impose the same sort of sanctions that we did against Russia, we would be essentially cutting our own throats. End quote. Okay, that is the end of today's episode of China Update. Near the end there was some noise next to my office, so I had to move into a different room. My apologies for the echo and the final part of today's video there. I hope you got some value from today's episode. Let me know in the comments below what you think of some of these developments. Have a wonderful Wednesday, and I will see you all tomorrow.